If you want to know where the market could potentially head next week, well then you are in the right place. In this video we're going to be looking at some key metrics as to what's happened last week and what we can expect to happen in the next week. We're going to be looking at some of your favorite tech stocks. We're going to be getting a broad market overview and understanding where exactly we can expect this market to head next week. So stick around and let's get straight into it.
Oh shit. Here we go again.
So of course we have seen an awful lot of volatility this week with it's basically been a lot of hype going into the market and then a lot of degrading of the market, essentially, with the tariffs being reimbursed again. So it's clear to say that it is very volatile. Last week I poised the market to be relatively bullish, but not massively bullish, and we have seen a relatively bullish action, but nothing really to say that it's been really bullish. So obviously we've seen the S&P up 0.4%. As of recording this, I would like to say it is currently 4 p.m. UK time. I don't know what that is US. It's probably around like 10, 12 or something, but I do have to drive across country after recording this, so I'm getting it out early. We've seen the Nasdaq up 0.4% too, the Dow Jones up 0.3%, and the Russell 2000 up 0.3% as well. So it has been relatively bullish, but it's not as bullish as we would have liked to see it. The drivers of this, of course, being NVIDIA's strong earning beats, where it was absolutely incredible. I think it was around $46 billion increase on revenue for the quarter, which is just absolutely huge. This company is showing no signs of slowing down, especially within the data centers, and which is essentially what you are looking for within NVIDIA. That's exactly what we want to see. However, unfortunately, bad news does travel much faster and much further than good news, and we are currently seeing now Trump says China violated trade agreement with the US, tariff face limbo, legal limbo. Essentially, what the China and US have agreed to is nothing. It's basically been put in limbo, as I've just said. They really do want the big dogs, the presidents, to really weigh in now, as they just feel as if they are getting nowhere. So again, bad news for the markets, essentially meaning that we are just now going to see more volatility for the next coming weeks. We did really want to see some sort of an agreement by now, and the fact it's currently taking this long is not a good, not a good sight, of course. However, on good news, we have seen the Fed's preferred inflation gauge starting to potentially cool, which is really good. So essentially, PCE has fallen. It is now at a 2.1% increase, which was below the 2.2% in which the economists had expected, which is obviously really good. But the Fed's target is still obviously at 2%. So there is still room for it to fall before the Fed starts deciding if it's going to start to cut rates. However, it is very clear to say that this does not include any impacts from the 90-day tariff pause between the US and China. So that is something in which we are still waiting to see the implementations of, or implications from, sorry. I expect we will start to see that around July time. So there's still a lot of time to wait for this data to come in. So earlier on in the week, there was, of course, a lot of optimism sparked within the market. However, a federal appeal basically stumped this out of the water again, which is not ideal for the momentum in the market at the moment, as we have seen a lot of cooling off within the market. Of course, my portfolio certainly took a hit because it's quite a high beta portfolio. It definitely started to fall down late this week. I was up a fair whack and then I was down straight back to reality, right now as of recording this. So please, US market gods, please send the markets up next week. But we will get onto why I actually don't want that later on in this video. Economic indicators for the first quarter earnings among the S&P 500 companies was approximately 13%. So that's where we were poised to be at. However, right now, from what I've seen before, we're at 6.1. That's probably changed. It was a few weeks ago since I saw that. So there is definitely concern around earnings currently. Consumer demand and CEO confidence are showing signs of weakening, with the latter experiencing its steepest quarterly drop since 1976. So there is definitely a lot of cause for concern, and I might as well get on to why now I'm actually a bit worried about the US markets. So if you are a keen viewer of this channel, which I do really appreciate you, then you would know that the Schiller's PE ratio is currently at 36, which is really not ideal. The mean for this is at 17, so it indicates that right now the markets do look massively undervalued, and the only way that this becomes more fairly valued is if the prices fall off or if earnings are good. And when we're seeing earnings being the worst since 1976, then it's fair to say this puts us in a very sticky situation currently. So right now there is definitely cause for concern within the US market. It's something in which I'm watching very closely. I do actually have my own US macroeconomic health score, in which I will now try and find for you. So last week when I made this video, the health score was at 63.4849, and now if I update this, let's actually see where this does change to. So according to my calculator here, which accounts for many factors from CPI to housing markets to you name it, it most likely has it in. We currently have a health score within the US markets of 68, which has obviously increased from its 63, in which I literally just showed you from last week. So it's clear to see that the US markets on a macro scale are heading into a more healthy territory, indicating that we could potentially see the Fed speed up the impact of its, the change within its, what's the word I'm looking for here? Interest rates. So there is actually good news, especially coming out of the PCE data. So looking forward to next week, what can we actually really expect to see? Well, it's going to be volatile for sure, but the key events to watch are US May jobs reports, which are going to be coming out. I should have a date later on in this video for you on that. These expect to show a slowdown in job creation to 130,000, which could be influenced by the Federal Reserve's policy decision. The OPEC meeting on Saturday to discuss potential increase in oil output, and it aims to maintain price stability. That will probably be out as you're watching this video, to be honest. And potential market movers will be continued developments in the US trade policy, particularly regarding tariffs, which are obviously going to be huge. I heard that countries like Germany have now put a 10% tariff on Google. Don't take that as gospel, because I just heard it off of another YouTube video, but that's kind of crazy. It shows that there is now a slight bit of a almost tariff war happening within the Western Hemisphere now, which is obviously not ideal. It just shows a bit of divide, which is obviously going to put markets in turmoil, and especially when earnings are not as good as they need to be, it's fair to say that this looks to be as if the market could potentially fall down very quickly from here. However, does that mean I still think it will go down? We'll get onto that after I've done all of my analysis later on in the video, so I have a broader perspective. Of course, another market mover will be the Federal Reserve's response to inflation and unemployment data, as that will be key for setting the interest rates. So looking at the VIX, we can see that this is currently, as of recording this, at 19.23, and ideally you want it to be below 20 under this new presidency. Normally it would be 17, but now we're all the way up at 20. So it does look to be in a more healthy place than we would like it to be if you were obviously short selling, but
What?
it does still look to be very high, so there is a lot of volatility still within the US market, so there is definitely that risk going into next week. And talking about risks, obviously there is the trade policy uncertainty and economic concerns, as rising federal deflect and high interest rates are compounding investor worries, which is obvious. I've been saying this for a while now, and of course the decline of CEO confidence within the market now. However, there does still look to be a lot of support under the market at the moment, as we are above all of the exponential moving averages, and on a MACD it is still well into a long position, indicating that this is still a relatively good time to be buying the US markets. However, you can't really go off of indicators with an ETF, because there are so many factors in which actually play into it. So we'll get onto other stocks later on in this video where we can really see where this will be heading. So looking at the economic calendar, on June 2nd, we have the jobs report, which is going to be released, of course. On June 3rd, we have the Federal Reserve's preferred inflation gauge, the core PCE price index, to be assessed, which will be important as well. And on June 5th, European Central Bank's decision on interest rates, with expectations of an 8 rate cut, bringing rates down to 2%, which is really good for the European markets. However, especially in the UK, I'm not sure for actually Europe in general, but inflation is definitely on the rise, so there is a lot of concern around that. Okay, so let's now move on to a section where we go over some of your favorite stocks. This is where we can allow ourselves to get a broad overview of the market and really understand where the market should move on an individual stock basis. And to do this, we're going to be starting off with NVIDIA, which has obviously had their earnings report this last week, which was absolutely huge. It was a surprise of nearly 10% on earnings, and revenue was a surprise of nearly 2%, which was really good. Data centers are still really strong, so NVIDIA looks to be is poised to be set up in a really good position going forward for the next few years of growth. They just look to be unstoppable at the moment, and it's fair to say that if you bought NVIDIA all the way down at the $100 mark, then well done. I actually did, but I was playing around with stop losses and it kicked me out, and then I just left it. I did buy back in around the 121 level, but I do wish I held it from 100. That was a mistake of mine. But again, I don't really like to buy falling stocks. I do like to see a bit of a momentum within the stock. I like to pay a bit of a premium to know that it's going to continue to go up. But NVIDIA does have a Fibonacci resistance level here set at $144, which is 6.3% off where we currently are. There could be a chance that it does catch up to this in the next week, but there's a lot playing on tariffs with NVIDIA at the moment. That is the main cause for concern. But even then, I still think when you're buying NVIDIA at, what is it now, like a 30, 40, 50 PE, it looks massively cheap. I really don't understand how people are actually shorting and selling their position within NVIDIA. It just looks to be an amazing hold to go forward with. And it is, of course, in a long position on the MACD with not really much sign of it slowing down, and it's above all of their exponential moving averages. So this hasn't been updated in well over a month. I should really do this, but NVIDIA has recently been downgraded in my opinion. However, it still looks to be undervalued. On the bullish side, I have this stock to be set at $185, and on the bearish side, it's only at $100. But again, once this is updated, this will look much more, bullish, of course. So again, fair to say, NVIDIA looks like a great price at this current price, of course. So definitely a stock to be long on at the moment. So now we're looking at KEG, or Constellation Energy, in which a lot of you who are keen viewers of this channel will know I have been, in for a while now, and it does look to be a great stock to be momentum trading. Its next level of resistance is all the way up at $340, and the current price is at $303. So what has actually affected this stock to rise 3.89% in its last week? Well, there has been obviously broad market conditions pushing up. However, the broader nuclear sector also saw significant gains following recent executive orders signed by President Donald Trump aimed at expediting new nuclear reactors. So they have now been approved, so it will obviously push KEG stock up. And again, I still have this stock to be massively undervalued. I'm probably going to struggle to find it now, but it does still look to be a stock in which does have a lot of momentum. It's not as undervalued as some of the stocks in which I have done reviews on. Their free cash flow is actually consistently poor, so there is definitely that in which they don't have going for them. But on the bullish side, I do have this stock to be set at nearly $500, and on the bearish side, only at $776. So it does look to be a stock in which could potentially go absolutely parabolic within the next few years, especially as AI demand on the US energy grid increases. It's just going to be a stock in which will see the benefits from this. So now moving on to Hims and Hers to get a broad idea of the healthcare market, we can see that this has had a really poor week. Again, I still have Hims and Hers to be undervalued if I can find it. I have them priced in at, and I recently upgraded them to be at $77, 75 ish. But it looks to be as if it's something in which could be well momentum traded, and it's looking more attractive now to be bought into. I wouldn't personally buy into Hims and Hers until it hits the $45 range. I think that's a good price target to be buying in at. But I do think it's still going to have a lot of momentum. However, it does look to be as if that momentum has definitely stalled now, and that's really not ideal. But it seems to be quite... you look at Novo Nordisk, another healthcare stock. This has actually recently opened up into a long position. This is something in which I'm keeping a keen eye on because, again, this looks to be massively undervalued. I do actually have a healthcare analysis video coming out later on in this week. It's fully recorded already. It just needs to be uploaded, and scheduled, so do keep an eye out for that. A little spoiler for you, Novo was the top pick of that, as it looks massively undervalued, but I'm not buying into a position, at least not a big position in Novo right now, just because why would you buy a falling stock? You might as well wait for it to break its first level or get close to the first level of resistance and show a lot of momentum, and then you can really swing trade it, momentum trade it, and gain the profit. But why would you buy it here when it's just going to fall down to here? So do keep an eye on that, and if you would like to come back to this channel, as I will be keeping an eye on it for you to an extent. So that does look to be a good stock going into next week potentially. So now looking at SOFI Technologies, this has also seen a bit of a bear market this week. However, it does, in my opinion, especially with PCE data coming out and the potential that the Fed will actually cut rates in the, well, near-ish to far future, probably late summer, I think it's fair to say that SOFI looks to be a good buy at these levels still. I have them to be massively undervalued, but it's really hard to say where they will actually end up. Again, this stock just continues to break my heart. I feel like I say this forever. Ever since it had a downgrade way back in, I think it was around December, the momentum just ended, and now it's just going sideways forever. It does look to be in a long position now, but it doesn't look to be as if it's going to end up staying in that long position for too long. But when you compare it to other fintech stocks such as Robinhood, this looks to be a much better option right now. It's well into a long position, still looks relatively undervalued, and it does have the momentum behind it. So again, if you're swing trading these, trying to get a bit of momentum, Robinhood is definitely the better option, especially when you compare it to something like New, which is just falling significantly and looks to be as if it's going to fall all the way down to the $10 mark, just because that's where it seems to be heading. But again, New looks as if it's actually starting to set up a reverse head and shoulders, similar to SOFI. So there is potential for this to actually somewhat break out in the near future, but it's really hard to say again. So now looking at Tesla, this has seen a lot of momentum in the last couple of weeks, with Elon Musk now resigning in his special government department of Doge. So it's fair to say that there is now more attention on Elon Musk and Tesla, and they have actually said that the first robo-taxi was in use around Texas, which is obviously massive, as it means that this project is actually going ahead. It's not just some crazy conference call where they say, oh look, we've got cars that drive themselves and they're going to pick you up and put people out of jobs. They're also now saying this is actually happening. So it's definitely something which could push Tesla up in the coming weeks. However, it's clear to say Tesla is massively overvalued. I'm not in Tesla for the long run. I do currently hold a position in Tesla to basically swing trade it and take a bit of this price, but if I was looking to be holding Tesla for the next year, not really a good idea. And I'm not saying it won't go up for a year, don't get me wrong, but there's definitely a lot of risk within Tesla. But Tesla's just a company in which is consistently intrinsically overvalued. That's just what they are. That's who they are. So it's not necessarily a bad thing. And if you are a Tesla holder, don't cry. Don't dislike the video just because I said something about your beloved Elon. I'm saying that this is a great company, but for me, it's very risky. And talking of risky, here is Palantir. Now, this has actually seen, especially today, a lot of momentum. It's broken through. Well, this is actually a level of support, but let's imagine its resistance here. It looks to be as if it's going to just continue to slide all the way up to the top. But again, I mean, Palantir's at a PE last time I checked of 600-700, which is absolutely outrageous. It's all the way down at 596 now, actually, at 69 actually now. So I mean, don't get me wrong. Wow, that looks so cheap. No, it definitely doesn't. Tesla has the potential. Palantir has the potential to fall all the way back down to the $60 range. However, there is a broad price target on. In fact, there was an indicator in which I wanted to look at here. This indicator basically says the price targets for these stocks. I'm going to have to try and hide something here. Bear with me 2 seconds. So it does look to be as if analysts are actually still expecting there to be a lot of growth. The mean is actually down at minus 21%. So again, that looks to be as if Palantir could definitely see it fall back down after this momentum has finally ended. And now finally, Apple. So looking on this indicator, Apple looks to be as if it's going to be undervalued for this year's growth. However, Apple is a company in which I just personally want to stay far, far away from. They don't really do anything anymore. The Apple car was a failure. The Vision Pro was a laughing stock. Their iPhones are, well, I mean, I've had an iPhone 12 or 13 or 11, whatever this is now, for the last, whatever, I don't even know, like 6 years, maybe 5 years, and I'm not going to be buying a new phone anytime soon. This is perfect. I think a lot of people are in that position now where why on earth would you buy a brand new iPhone for the sake of it, you know? And the iPads are good, the MacBooks are good, everything they do is good, and it's good for a long time now. It's not like you're back in the iPhone 6 era where it's like, oh, my phone's crap, I need a new one now. They're all really good now, and they're consistently good. So it's why on earth would you keep buying them? And now their old designer, Jonathan Ive, I think that's his name, has now moved to OpenAI to work for them on some new products. So there's a lot not going for Apple at the moment, and of course the effect of tariffs, especially implemented on Apple. So it's something in which I'm staying well away from, despite the analysts expecting a potential of 50% upside for this year. So this is now the section where you've probably skipped to. This is where I actually go over my prediction for next week. And to do that, let's just go over a bit more data. Sorry to you TikTok watchers, you're probably struggling to retain your attention right now. So with the market strategy currently looking to be within a concern over the tariffs, there is some analysts advising investors to remain engaged, and as fundamental support for the market seems poised to improve, it does look to be as if there is a lot of bear activity in which could occur next week. However, while short-term risks and political maneuvers still are existing within the market, longer-term gains remain very much possible, with forecasts suggesting the S&P could end the year at 6,000, which when the current price of the S&P is, I think, 5,000 and it's 5,894 currently. There is definitely an upside, but not much from here, according to the analysts. So it looks to be, and I do actually think that's relatively accurate. It's accurate to what should happen, but whether that's accurate to what will happen, I am not entirely sure. But according to earnings currently, I think that's a very accurate reading. So, but I do think it probably will surpass that just because of the momentum. You need to understand that these days, investing isn't about really holding it long term for a lot of investors, me included. It's about playing the game, playing it right. And as bad as it sounds, you're taking other people's money, you're taking exit liquidity, right? You try not to be exit liquidity, you're taking the exit liquidity. So 6,000, very accurate for what should happen, but will happen, most likely, probably not. It should surpass that in my opinion. And if you want a key takeaway of what the big hedge funds are thinking for next week currently, well, according to ChatGPT, which has summed up all of the hedge funds for me, it said cautious.
Sometimes may be good, sometimes may be shit.
So the hedge funds are definitely showing caution going into next week, which is very fair. We do have a lot of big things coming up, such as core PCE, which is going to be huge. A few big earnings coming out as well. Obviously nothing on NVDA, but there's a lot of volatility coming next week. For me personally, again, it's really hard to call where the market will move because many things can change even by Monday, and as of recording this, it's 5:30 for the UK time, so it looks to be as if there could be a lot to change, but I will say next week looks as if it could be set up to be bullish, especially because the end of this week has been so bearish. But it's hard to say. I think it's going to be bullish, but there's a lot of reason to say why it won't be. And when I do actually ask ChatGPT on its opinion for next week's movement, I said bullish or bearish. It just said neutral. I said, give me one word, please, and it said neutral. So it looks to be as if, ChatGPT is actually quite accurate with this sort of stuff. So it does look to be as if we might see a lot of sideways action next week. Again, it's impossible to call at the moment with the current macro climate. But on the macro side of things, again, we're looking to be as if we are actually increasing here on the health score. Obviously, we're still in a awful position relative to its healthy score, so there's a lot of work that needs to be done, but it does look to be as if it will be heading up soon. So like I said, relative to US time, it's still very early in the markets currently, so after post-market or after hours, I will be leaving a comment on this video as to what has actually changed, if anything has changed in this video, because there is a lot of potential for there being a lot of volatility in after hours, and I just can't justify staying around to record it because I do have a lot of driving to do tonight. So with that being said, I have been mechanical markets. I don't know why I've said that. I've never said that before. I will never say that again. I don't make a single penny off of these videos, so if you could leave a like and subscribe, it would be greatly appreciated. None of this is financial advice. You should always do your own research before investing into the stock market, as when you do invest, your capital is at risk. And I will see you for the next video.